Okay, we are back. I'm very happy to have on the Goldstein on Gelt Show, Dr. Thomas Howard, who is the co-founder of a company called AthenaInvest. In fact, he serves as the CSO and the CEO and the director of research and the chief investment officer. And I found Tom because of a speech that he delivered at the CFA Institute annual conference called Behavioral Finance, Reject the Model, Not the Real World. Tom, real pleasure to have you.
Thanks, Doug.
So in your talk, you spoke about, in fact, I think the term that they quoted you on was the interplay of uncertainty and emotions drives us to make suboptimal decisions, which I guess is just a fancy way of saying when your head is spinning, you make bad choices. Is that what you were saying there?
That's exactly right. There's two things that are going on with individuals in trying to make decisions in this situation. Number one, people make decisions based on emotions. That's kind of our fallback way of making decisions. It's hardwired into us. It's allowed us to survive and thrive as humans. And so we fall back on that particular approach. However we feel about something, whatever emotions we're feeling, we make decisions. The second part of that is that people are not good at estimating probabilities. They tend to overestimate the probability of significant events that may have actually a low probability but kind of devastating results. And so we have all kinds of examples where people have a very difficult time estimating what is the probability. You put those two things together and you end up with some very poor financial decisions.
Okay, so before we dive into that a little more, a lot of times people tell you, the coaches and the business consultants always say, go with your gut, do what you think is right. Why does that not apply in investing?
Well, in many situations it does, but in investing, it just doesn't work at all. Almost everything is counterintuitive when you're making investing decisions. This is also true of many economic decisions. So going with your gut is generally a very poor way to make the decisions. We talk about the 5 big triggers, emotional triggers. And so if the investment you're looking at or the financial decision you're making has something like that in it, you'll tend to make a decision to move away from that investment, even though it may generate tremendous returns over the long run. So going with your gut, and we say this as we manage money, we don't use our gut at all. We don't use any emotions in making our decisions and what investments we're going to go into. We do take advantage of what we call behavioral price distortions because many individuals do make emotional decisions. But when we actually manage money, we remove the emotions from the process.
So I don't want to make this a political discussion, but as you're saying this, I'm beginning to think about, I'm sure you remember, not so long ago, the market had a big meltdown in 2008. And people like you and me who are on the financial advising or money management side, we were talking to clients and people about the importance of staying the course. And like you're saying, don't just get all tied up in your emotions and sell, into the crash. We tried to talk to people about planning and exactly what you said, not dealing emotionally. The problem is, not only does the market overall seem emotional, but look at how the government was making decisions. Literally, if you looked at the Ben Bernankes and the Tim Geithners of the world, in a weekend, they would be opening and closing, multi-billion-dollar businesses. This couldn't have all been well thought out. They just didn't have the time. So if the market's so emotional, shouldn't we be dealing with that?
Well, yeah, you're absolutely right. There were a lot of emotional decisions made then. But we've found that if you, again, step back, remove the emotions, you've got to have some kind of objective measure that tells you whether this is a good investment or not, whether it's an individual stock or a market or a particular fund manager. And you use those particular objective, measurable, persistent measures for making those decisions. And even though everybody around you is losing their head, you use those and make those decisions. So for example, in our global tactical portfolio, which is a top performing tactical portfolio here in the US, we went double long in the Russell 2000 in early 2009 in March and April. And of course, everybody looked at that and said, that just doesn't make any sense. There are just Obviously, we've just gone through the emotion of the 2008 meltdown. But our measures said that's what you should do, so we did it. And it turned out extraordinarily well. Those are the opportunities that can allow individuals to build significant long-term wealth if they focus on those measures versus the emotions.
All right. We're talking with Tom Howard, who is the Director of Research and CIO, the Chief Investment Officer at Athena, a registered investment advisory company. Tom, I want to touch on something you just said, because one of the terms you used, I'm not sure all of our listeners will be familiar with, when you said double long. What did you mean, and what tools do you use to do that?
So in this particular portfolio, which is our global tactical, we have what we call deep behavioral currents that tell us which markets are the best, have the highest expected returns. And so we will move among several different markets based on this criteria. If the signals are strong enough, we will actually leverage the portfolio, which means that if the market goes up by 5%, this portfolio goes up by 10%. We use leveraged ETFs to implement that particular strategy. So when we're talking about a double long, we're talking about a leveraged portfolio. It's very much like buying a stock on 50% margin, very similar sort of behavior.
Mm-hmm. Is that the type of tool that you would recommend for individual investors to use, or really is that kind of too hot to handle for the average guy?
Well, you've got to have a reliable signal. And we research very carefully. We have a very large database over a long period of time. This particular portfolio we've researched back to 1980. So you've got to have a reliable signal, something that is tested out over a long period of time, a large database, before you make these kinds of decisions. Otherwise, you're just using your gut. I mean, if your gut is we should go double long, then that's not a good decision at all. Who knows whether that's going to work out, and probably it will not.
So it's got to be,
because again, as I said, our emotions tend to lead us in the wrong direction in these kinds of situations.
So it has to be part of your overall strategy. There are a lot of different strategies for handling portfolios. We, in fact, had here on the show Nobel Prize winner Dr. Harry Markowitz about a month ago. He spoke to us about modern portfolio theory, and you talk a lot about behavioral portfolio management. Do these two work in concert, or are they kind of totally different approaches to managing money?
They're totally different. And unfortunately, modern portfolio theory, and I started out my career in the late 70s, got my PhD, was a strong believer in modern portfolio theory, very much a quantitative person, and the evidence just kept getting worse and worse against it. And then as I began to develop and evolve my own particular approaches, I began to move into the behavioral area and how the role emotions play. And it dawned on me that modern portfolio theory enforces emotional decision making. It is the underpinning of the markets and of the industry these days. And unfortunately, it encourages emotional decision making because it is largely built on, and Harry Markowitz started this with his mean variance optimization. It's largely based on volatility as measured by standard deviation. And volatility is all emotion. There's very little fundamentals in there. And so if you build your portfolio based on that, you are making a return emotion decision. And you end up with underperforming portfolios as a result.
So then let's focus a little more on behavioral portfolio management. Someone who wants to begin to develop the skills there, what are the areas he should focus on in order to become a better investor?
So there's really three parts to it. The first part is that investors need to they're going to experience emotion, but they've got to get to the point where they're not making their decisions based upon the emotions. We call them, again, the 5 big emotional triggers. And you're going to react to those things emotionally, and we're just hardwired to do that way, but don't make a decision based on that. So that's a first, and that's a huge step. As we say, emotions are the most important determinant of long-term wealth in an investment portfolio. So an investor that can do that can add hundreds of thousands, if not millions of dollars to their portfolio just by that step alone. The next step is building portfolios, as we do, based on behavioral price distortions. That is, most investors don't manage and control their emotions. They end up making what we call cognitive errors. And since we're all hardwired in the same way and we tend to like to move in crowds, we end up distorting prices. And you can build portfolios, and that's what we do at Athena, based on those price distortions. We're harnessing those particular distortions. We've got to have an objective, measurable way of detecting those particular distortions, and they have to be persistent. So that requires a fair amount of effort.
Yeah, let's not focus on any individual stocks because I don't want people to walk away with some specific feeling they've got a recommendation. But let me just ask, how would you do that? In other words, let's just say before 2008, when the prices of homes were going up and real estate was really shooting up, and some people called it a bubble, but other people said, okay, the market is hitting its true value because that's the free hand of the market. How can you step back and see that there's really a mistake going on there and that people are in fact investing emotionally?
So again, let's go back to our global tactical portfolio where we look at markets. We have a measure of deep behavioral currents in those markets. We again tested it very thoroughly over a 30-year time period. And we look at those deep behavioral currents, and they tell us which markets are the strongest. We don't happen to have real estate in there. We just have equity markets and also treasury bills. But when those signals come through based upon our extensive research, that's when we make a decision, whether we move into a particular market, whether we leverage that market, or whether we're in cash, whether we're in treasury bills. This particular indicator told us to be in cash during 2008. And there may be that sort of opportunity in real estate as well, as you talked about, but I haven't studied it. I haven't looked at it carefully, but that requires a considerable amount of effort. Again, if you don't do that, then you depend upon emotions and intuition. Gee, my gut tells me that I ought to do these sorts of things.
Right, and you have to be careful. And also, based on what you're saying, it's important for people to realize that as you do get more involved, don't invest in things that you don't understand or don't have the time to manage, which in fact is why you work with a money manager. Tom, we're just about out of time, but in the last few seconds, tell us, how can people learn more about you and the work that you're doing?
You can come to our website, AthenaInvest.com, and we have all the information available there. Both on our research and the products that we deliver to advisors. So that's a great source of information.
Okay, we will put a link to that at the show notes of today's show of Goldstein at goldsteinongelt.com. Tom Howard, thanks so much for your time.
Thanks so much, Doug. Thoroughly enjoyed it.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.